It's important to know that we have been working with RBC for the past 3 years, and we have managed to close some significant deals together. So therefore, it is ideal for this bank to basically be a part of our debut seminar. As some of you may have known, we have been providing auditing, taxation, business advice services over the past, since 2004. In performing our services, we find ourselves asking some questions to business owners and managers. These are: do you have a documented strategic plan? Do you have an operating plan? Do you prepare budgets? Do you prepare and analyze monthly financial statements? Have you ever done an organization review to verify that your business processes are relevant and efficient? Are you sure your internal control systems are strong enough to safeguard assets? Do you have an IT security policy? Do you have a marketing strategy? Do you conduct feasibility studies on new projects and business? Do you have an exit strategy? Do you have a succession plan? Do you have any tax planning policies and procedures in place? Most of the responses to these questions are usually no. This is not good, as these are critical to any successful operation. These are the reasons why we believe that business seminars like these will remind business owners and managers about the important tools and information that are essential in running a successful operation. It is important to know that we as business people are the hope of Jamaica's economic problem. Believe it or not the government, not IMF, it is us. We need to grow our business. We need to create wealth for ourselves and also wealth for the wider population, through employment, etc. We at DGS believe that it is our responsibility to assist businesses to grow and be successful for the benefits of our country. I am sure that you will gain from this seminar, and we are available to provide value-added professional services that will benefit your organization. Welcome again. Thank you for coming, and enjoy the show.
And I'm a Senior Relationship Manager for the Business Banking Unit at Royal Bank. Okay, this morning, RBC Royal Bank is extremely delighted to be partnering with DGS Chartered Accountants and Business Advisors to present this informative business seminar entitled Managing Business Risk and Performance Through Information and Planning. In today's fiercely competitive environment, we understand that there are a number of things that weighs on the minds of business owners and senior business managers. These are linked to various issues, including the stage of the business's life cycle, how the company can improve efficiently on its core business, and what are some of the ways to implement and maintain strong internal control systems. We understand that these thoughts can keep one up at night. Growing businesses are often worried about how to manage this growth, how to control risks associated with growth, and how to access financing. young entrepreneurs are looking at how to prepare a workable budget and improve their efficiencies. RBC Royal Bank understands the need for enhanced advice that will assist you in making that next important decision. Our partnership with DGS today helps us deliver on that need. We continue to monitor the Jamaican marketplace to ensure that we can anticipate your needs and serve them well with the capabilities of RBC's global capacity. Strengthened by a highly capitalized, healthy, robust international banking leader, which is our parent, Royal Bank of Canada, our company is well poised to seize these novel opportunities and create better futures for you, our clients, for our employees, and for our communities at home. We hope that you will garner here today. We hope that what you garner here today will prove beneficial to you and your businesses. And as the business banking unit at RBC is committed to improving our clients' experiences and working together to achieve your success, we encourage you to approach one of our relationship managers who will be more than happy to speak with you about your specific challenges and or visions, and who will work with you to provide appropriate, realistic, and effective solutions. Once again, we thank you for coming this morning and hope that you will find this seminar both beneficial and useful. Thank you.
You will all agree that the economic climate in Jamaica at this time is not business friendly. But while we are agreeing to that, we must be wondering to ourselves, why is it that some companies are growing while others remain stagnant and on the verge of failure? When we look at the statistics relating to business failure, we realize that in the United States of America, an average of 75,000 businesses fail each year. In Canada, an average of 35,000 businesses fail each year, while in Jamaica it is estimated that an average of 1,200 to 1,700 businesses fail each year. Now, it's important for us to look at the statistics of other countries, because research has shown that regardless of the country that you're operating in, there are certain common factors that contribute to business failures. So what are these factors? No planning is one. Poor management, lack of financial information, neglect for the business, inadequate control systems, and inadequate financing or capital. So how do we fix these problems? What should we do? We need to be having or doing strategic and operational plans. We need to be preparing and analyzing periodic financial statements. We need to be continuously improving our business processes. And we also need to be implementing and maintaining strong internal control systems. And this, ladies and gentlemen, is what my presentation will be about. I will be looking at all of these and looking at how they can help our business to perform better or save them from failure. So firstly, let's look at strategic and operational planning. This is all about planning for the future. Because if you don't know where you're going, then you won't get there. And even if you get there, you won't know that you're there because you didn't know where you're going. Right? You also need to have a clear picture of success for your business. Because if you don't do this, then it is likely that you're going to fail or you probably don't grow. You just remain stagnant. And as the popular saying goes, if you fail to plan, then you're planning to fail. So we need to be doing our plans. Now, our strategic plan will look at the long-term objectives of the company and the strategies to achieving them. And these strategies should be about enhancing your business performance, And when we're doing a strategic plan, we normally do a strategic plan for a period of 5 or more years. Now, what are the benefits to be gained from strategic planning? There are numerous benefits. Firstly, it gives you a chance to start planning for the next 5 years. So it puts you one step ahead of your competitors. So it gives you a competitive advantage. It identifies business opportunities. It looks at your resource need, whether or not you have a cash, a shortage of financing. Right? It looks at whether or not you will need additional staffing. It also looks at whether or not you will need new machinery or equipment soon. It also identifies, very importantly, pitfalls within your business, right? And this is very important. We don't just look at opportunities, but we also need to be looking at the pitfalls that we can come across in business. It also helps to determine whether or not we need to forge an alliance with the next company to help us to perform better. It identifies certain critical business tools such as succession planning. So I'm sure some of the times you might think to yourself, you know, how would I manage? How would my business manage without a particular employee, right? You know, what succession planning does is that it ensures that you have a backup plan for that employee just in case he drops down and dies tomorrow morning, right? Or your competitors has taken him away from you, him or her from you. So so the strategic plan helps to identify that. It also looks at your exit strategy. Right? What is it that I'm going to do with my business when I get old? Or is it that my retirement is at 45, so I'm not going to wait until I get old? What is it that I'm going to do with my business? Am I going to give it to my son? But is your son interested in the business, or is he more interested in becoming an entertainer? Right? Things like this, a strategic plan actually does. It also helps to determine whether or not the industry in which you're operating will be declining anytime soon. And these are very, very important stuff that we need to be looking at. So a strategic plan will help to deal with these. Now it also looks at the major risk which our business may come across. And some of these include our credit risk, our foreign exchange risk, our concentration risk. And it also helps to deal with how we'll manage these risks. Now, your credit risk is a risk that your suppliers may not pay you. And how do we manage this risk? We need to ensure that we have good credit processes or procedures in place. So we need to have a system of approving our credit customers. We also need to be following up regularly on overdue balances from our customers. Now, our foreign exchange risk is a risk that our business will lose money in the event that there is a change in the foreign exchange rate. Now, want to manage this risk? There are certain recommendations. For example, we want to ensure that we do not take a loan which is in US dollars when our earnings is actually in Jamaican dollars, right? And if you can avoid this, what we are suggesting is that you actually hedge against this risk. Now, the concentration risk is the over-reliance on one supplier or a customer. And the bank will quickly tell you that they will be less inclined to lend to a customer who has a high concentration risk. But even worse, a customer who has a high concentration risk, because sometimes you're in business and you can't avoid having a high concentration risk because the opportunity exists for you to make some money and you're making some money. But the risk exists, it is inherent. But what is important is that you need to be managing this risk. You need to have a policy in place in terms of how, a backup plan in terms of how you are managing this risk. Now, we have looked at the operation, the strategic plan. The operational plan now will focus on the short-term ways of achieving these strategic plan or the long-term objectives. And it will include the preparation of realistic budgets. Now, every company needs to prepare a budget, because even more so because you have various changes within the business environment in which we operate. Do we expect increased competition? And if we expect increased competition, what is it that we're going to do to counter this increased competition? Are we going to be lowering our selling price to drive the competitor out of the market? And if we're going to lower selling price, then we must be capturing this inside of our budget. Do we expect shortages in terms of the material that we're using? And what are we going to do to deal with this problem that we're going to be having? Is it that we're going to be buying more than we normally buy to fix this problem? Or is it that we're going to start researching to find new suppliers to supply this material? Right? These must be captured within your budget. Your budget should also capture information relating to additional resources need. So, is it that during Christmas time I'm going to be needing additional staff? Or when is it the best time of the year for my staff to be taking leave? All of these need to be captured. Your budget will also help your organization to function in a more structured manner. So instead of operating haphazardly and just moving along, the budget will help to structure you. So you have your targets and you're working towards your targets. And very important is that the budget helps to identify cash flow shortages, right? Because you need cash, takes cash to hear everything that we're doing basically. So the budget helps us to do that. Now, our approach to budgeting is also important. It is important that we do not take an incremental approach to budgeting, right? And this is the traditional, this is what most people normally do. And by incremental approach, we mean taking last year's numbers and adding a percentage to it and calling it this year's budget. Whatever conditions that existed last year, for those numbers do not exist now, right? What we need to be doing is that we need to be taking a zero-based approach to budgeting. And by this we mean, we need to be justifying all the numbers that we put inside our budget. Every single line item must be justified. And by doing that, what we're doing is making our budget more current. So by making our budget more current, it's easier for us to respond to changes in the business environment. Now, also, we need to be taking a participative approach to our budgeting. We don't need to be at the board level and setting the budgets and pass it down to our employees and say, here's the numbers, this is what you need to achieve, and this is your targets, and you need to do this by X time. Right? This will tend to demotivate the employee. We need to take a more participative approach. We need to get them involved in the decision-making process. So once we do that, what will happen is that these persons will feel a part of the process. You feel welcome. You feel like you're a part of the company, and you have to make the decision relating to the budget. So you'll be more inclined to achieving the numbers. Because if you don't achieve them, then you will look bad as well. We also need to remember not to ignore budgets when we're doing new projects, new departments, and new acquisitions, because these tend to be very costly, right? And we need to be budgeting for these situations. By not doing a budget, we're basically operated by chance, and the chances that we're going to fail. I would imagine that every time that you get in your car to drive, you have an idea of where you're going to end up. And you also have an idea of the routes that you're going to take to end up there. Because if you don't know where you're going to end up, you'll be driving to nowhere. It's the same approach that we need to be taking when it comes to business. We need to be we need to know where we're going, our long-term plans. We need to know the routes that we're going to take, which are our operating plans. Right? Because this is very important. Because this will help to determine where your business will end up. So, we have looked at plan, right? Strategic plan, operational plan, which includes our budgets. Now it's time for us to look at the actual results. And the actual results will be captured within our financial statement. Now, a complete set of financial statement comprises of a statement of financial position, which is popularly known as a balance sheet, a statement of comprehensive income, which is also popularly known as a profit and loss, statement of cash flows, statement of changes in equity, and very important, the notes to the financial statement. The statement of financial position or the balance sheet, it basically looks at the financial position of the business at a particular time. So it basically captures all the transactions that have ever existed in your business. It gives you a snapshot at that particular date. It is made up of the assets and the liabilities and the equity. Simple. Now this is a simple balance sheet or statement of financial position, and it shows current asset of $900, current liabilities of $1,300, and a net current liabilities of $400. Now, by looking at this, it seems that this company would want to be talking to RBC about getting some financing. And it also shows your property, plant, and equipment, which is basically your long-term assets, and it also shows the equity. And we'll be using these numbers when we're actually analyzing the financial statement as we go along. Now, the statement of comprehensive income are your profit and loss. It captures all the revenue and the expense for a particular period, and this is normally for a year, right? But we also, it could be for a month, a quarter, etc. And the end result of that is it is our profit or loss. And this is what most people are interested in. So this is a simple example of what a statement of comprehensive income looks like for A Limited. And it shows that A Limited has a gross profit of $1,500 and net profit of $300. Now, by looking at this, the owners of A Limited are probably comfortable because they're in business and they are making a profit, so they are meeting their objective, right? Or so they might think. Now, so we have looked at the example of the balance sheet. We have looked at an example of the income statement. Now we're going to be looking at the statement of cash flows. Now, and you probably sometime in business that you wonder to yourself and you say, well, I've generated so much sales this year, but yet still I'm struggling to find money. Where have all the cash gone? This is what the statement of cash flows answer. Right? It answers these questions. So it highlights the cash that has flowed into and out of the business during a financial period. It also shows how well a business has generated cash. Where are you generating the cash from? Is it from your core business or is it from loan? This is very important. And it also shows whether any extra long-term funding was raised during the period. Did you get any long-term loan? Or whether or not you actually purchased or sold any long-term assets. These things are captured in a statement of cash flow. So you realize that by the three statements that we have looked at so far, all of them are important because they show different things. So not just your profit and loss. And this is a simple example of the statement of cash flow. And it shows the net cash flow from operation of $700. And this, ladies and gentlemen, is one of the most important cash flows. Right? It's cash flows from operation. Because if you cannot use your core business to generate cash to sustain your business in the long term, then it makes no sense. Right? So your cash flow from operation is one of your most important cash flows. Then it also look at your cash flow from investing activities, which is basically deals with the purchasing or sale of any long-term assets. And then the next cash flow that it looks at is the cash flow from financing activities. And this cash flow basically deals with any long-term financing or any money received or paid out as a result of equity investment. So the end result is our cash resources at the end of the period. And very important is that this figure that we are seeing here is the same cash figure that is on our balance sheet. Because that is what we are proving. How the money was spent through the year. The money that came in, how it was spent, and how much money is left. Now, here's a point for you to ponder on. Is the profit that a business makes a reliable indicator of its cash balances? What say you? It's not? Or you're bright people, man. So it's not a reliable indication, because what will happen is that the business may have a lot of money tied up in. So it is profitable because it generated a lot of sales, but it may have a lot of money tied up in inventory, receivables, or it may have invested in long-term assets. Now, none of these will be captured when you're actually doing your profit when you're accounting for your profit, but they will certainly be captured when you're accounting for your cash balances. And this is a statement which basically states that profitable business can fail because they do not have adequate cash. And this is familiar to a lot of people. They are profitable, but they are still struggling. They need money, they need cash. Right? Now, this is a simple example for us to look at. It says, company made large profits in 2011. The statement of financial position is also showing that the company had a lot of money in the bank. However, the suppliers of the company only wants to operate on a cash basis with this customer. Why do you think this is so? What any answers? We have a basket from RBC that we're actually giving away, so the person that answer is closer to getting the basket. Right? Any answers from anybody? Alright, what might have happened is that somebody is answering. What might have happened is that the company is profitable, right? And it's obvious that they are converting the profit into cash as well, because as it says, the statement of financial position is showing that there is money in the bank. But the suppliers of the company only want to operate on a cash basis. What it may mean is that this company is not practicing proper working capital management, so they're not paying the suppliers. So they love to see the money in the bank. A lot of people love to see the money in the bank, right? But you're not settling your obligations, which is bad for business. Right? It could also mean that the company is dealing with new suppliers, so they want you to prove yourself first and to have a relationship with you first before they actually decide to give you credit. But importantly, it is possible that the company is not settling their obligation. Now, we have a next example. Example 2, which is like the reverse of example 1, where we have a company is very profitable. However, the company is unable to pay its suppliers and its bank loans. And this probably is a more familiar, in the Jamaica climate, it's probably a more familiar situation, right? So, what do you think is the problem here? Yes. So the company is profitable, but what happens is that the company might be doing a lot of credit sales. But those sales are not being converted to cash. So you'll have a lot of money in receivables, right? Hence the reason why this company may not be able to settle its obligations. So our experience have shown that. So let's recap. We have looked at for the financial statement. We have looked at the statement of comprehensive income. We have looked at the balance, which is the income statement. We have looked at the balance sheet. We have looked at the cash flow, and now we're going to move on to some other important matter, which is the interpretation of the financial statement, etc. But before we do that, right, what we realize is that our experience have shown that most businesses only prepare financial statements for tax purposes. So whenever you're getting a tax audit or you get a call from the tax department, then you're interested in doing financial statements. Or when they actually want a loan from the bank and you go to the bank and the bank says, well, listen, you need to show us a track record. What have you been doing in business for the last couple of years that you have been in business? Show us. So that is the time when you're interested in actually preparing the financial statements. Now we also realize that as a result of this, a lot of businesses don't know whether or not they're profitable. And seriously, you're in business to make profit. You at least need to know whether or not you're making profit. In some cases, even though the financial statements are prepared, we realize that people concentrate on the profit and loss. Right? They only want to look at the profit and loss to see the bottom line, to see how much money I've made during this particular period. Right? So, we also realize that some people don't look at it any at all, or they don't analyze it. Now, there are more important things that we need to be doing with the financial statements. Right? We need to be looking at the notes to the financial statements. We need to be looking at all the statements and we need to be analyzing and interpreting the financial statements, right? By calculating certain key ratios and determine what they are telling us, right? So the notes of the financial statements help to explain specific items in the financial statements. It provides a more comprehensive assessment of the company's financial position, and it also reveals information which are not, you cannot just look at and get on the statements such as the P&L and the balance sheet and the cash flow. It provides additional information that will help you to determine what these statements are saying. So therefore, the notes to the financial statement is very, very important. Now this is how the notes to the financial statement is normally structured. Note 1 normally tells us about the type of business. What type of business are we in? Are we a manufacturing company? Or is it that we are buying and selling merchandise? Note 2 is normally the policy note, and it tells the accounting policies used to prepare the financial statements, such as depreciation and the impairment policy. And this is important because accountants don't just come up with these figures, sit by themselves and come up and say, well, you know, this is how I'm going to be accounting for depreciation. I'm going to put fixed asset on the P&L, and I'm going to put depreciation in the cash flow, etc. Right? No, we are guided by international financial reporting standards, right? Which tells us how we go about preparing the financial statement. So depending on the accounting policy that is used, then the financial statement may yield different results, right? So it's important that we know the accounting policies that we are using to prepare the financial statement. Now, Note 3 onwards normally provides additional information to explain items on the face of the different financial statements. So, we have looked at the notes, and we need to be looking at the, now more analyzing the financial statement, looking at key ratios to see what they are telling us. And the first ratio is, first of the key ratios is the debtors turnover ratio. And this helps to determine how long it takes for your customers to pay you. Right? And it is calculated by your credit sales divided by your average debtor. Right? And based on the example that we looked at in terms of the P&L and the balance sheet, based on those numbers, we realized that the credit sales, all the sales was basically on credit, and the average debtor was $400 for the year. So we realized that the debtors turnover ratio is 12.5 times per annum. Now, this is now used to calculate your receivables days, right? And the receivables days is how long it takes for your customers to actually pay you. Now, it's the 365 days in the year divided by the 12.5 times, which is our debtors turnover ratio. So in this case, our customers are taking an average of 29 days to actually pay us. Is this good or bad? Yes, it depends. Right? So we want to be using this with our creditors turnover ratio. So when I look at the creditors turnover ratio, it helps to determine the length of time it takes for you to pay your suppliers. And it is calculated by the credit purchases divided by the average trade creditors. And in this case, we realize that we're taking an average of 94 days to pay our suppliers. Now, I can't imagine any business is actually waiting 94 days for payment, right? But when we compare this to our debtors turnover ratio, those two together, then we think that we're in a good position because we're receiving our money. We're taking the goods from the suppliers, selling them, and receiving our cash in 30 days, and we're taking 94 days to pay our suppliers. So we can do this 3 times before we actually pay our suppliers.
Mario,
yes?
so we run the risk of running into trouble with our suppliers?
Thank you very much. That's exactly what we do. So it depends on the terms that we are in with our suppliers. If your suppliers is giving you 30 days and you're taking 94 days to actually pay them, you're ruining the relationship, right? And hence the reason probably why the suppliers were demanding a cash on demand basis for payment. So we need to be using these two ratios together, the debtors turnover ratio and the creditors turnover ratio together, because they work hand in hand. Now, how can it help you? Now, this is like a reverse situation. If you calculate your debtors turnover ratio, and it shows that your customers are taking 30 days to pay you, right? While their suppliers require that you pay them within 15 days. What does this situation tell you? And what's very important is what strategies should your business employ to fix this situation. What say you? You have a shortfall of 15 days in financing your operation. Alright? Now, if this is unavoidable, again, your collection procedures. So you probably get some person set up a collection department to actually follow these customers who are outstanding. Because it is possibly, you know, that the 30 days that the customers are taking to pay you, they are really going overboard because the term is actually 15 days. So possibly you need to tighten your collection procedures. Now, our inventory turnover ratio, it shows how many times for the year you sell and restock your inventory. And it's somewhat directly related to the amount of profit that you make, because the more times you sell stuff, and the more time you have it, higher inventory turnover is some indication of your profitability level. But in some cases it's not, because what you will have is that you probably don't have the money to buy the stock, so you buy less than what you need, which will end up being more costly. So you can't just calculate it and say, well, then I'm doing this 50 times for the year. You have to look at the conditions in which you are doing so. In the example that we looked at, this gentleman is actually turning over his inventory 8.7 times per annum, which means that it takes him 42